What's up, everybody? It's Professor Reiko doing another example here on Treasury stock. So if you go back and look at the last video, the fifth one in the stockholders equity chapter, it's when we first did Treasury stock, and I felt it was important enough to do another example here. So this one looks a little different, but when it gets right down to it, we're doing the same thing. All right, so if we look here, we've got some issued and outstanding. So once again, remember, issued and outstanding are the same number, which means there's no Treasury stock at this point in time. All right, so we've got these shares that were issued, $241 par, that paid in capital. That's what it was issued for. So basically, what this is saying is, like when this, let's just assume this happened in one journal entry. We'll write it down here. So they would have received cash, they would have credited common stock, and additional paid in capital common stock. All right, so we can see here the cash number is, the common stock number would be par value, 240,000. This number was 3840, and which means this number would have been 4,080,000. All right, so what that means is this is the $1 par. This works out to be $16, which means they would have issued them for $17, assuming it all happened at one time. All right, now remember, when we get to the reason I'm writing this out is because if I already know that this last journal entry is going to be retiring, and we need to know these two numbers here when we retire the shares. So we'll get to that in a minute. So anyway, so now in this example, we already have the shares outstanding, so we're just going to walk through these journal entries. All right. It also says to prepare the stockholders' equity section of the balance sheet. I'm probably not going to take the time to write all that out. I usually do that in class, but didn't make it a little lengthy here in this video. All right, so on June 1st, we are reacquiring 15,000 shares of common stock at 15. So when we're buying back shares, remember we call it treasury stock. Now we are using the cost method, so we're buying 15,000 at $15, so that's $225,000. And we're just paying cash for that. All right, so $225,000. All right, so I'm also going over here to the side, going to keep up with my issued and outstanding because that's important to keep up with. All right, so remember, issued and outstanding in the first journal entry, I'm going to leave all the extra zeros off. It was $240,000. All right. Now remember, outstanding means still in the hands of shareholders. So we just bought 15,000 back. So that means there's only 225,000 still in the hands of shareholders. All right. Now remember, the difference between these two numbers always has to be the number of treasury shares that we're holding. We're holding 15, so that all matches up. All right. July 1, we sold some of these shares back. All right. So remember, if we're selling them back, we're going to get cash. All right. So we're selling 5,000 shares at $20 per share. All right. So that's $100,000. Skip a space here. We need to take the treasury stock off the books at the original cost, which is 15. So 5,000 times the 15, the original cost would be $75,000. All right, and then remember our difference here is 25,000. So like I said in the last video, remember treasury stock, it's a debit balance. It's a debit balance because it's a contra equity account, not because it's an asset. With that being said, that means we sold this for more. Remember, we bought it for 15, sold it for 20, but it's not a gain, all right, because we don't have recognized gains on dealing with our equity transactions like this. All right, so this we call additional paid in capital dash treasury stock. Okay, so as I did in the last one, whenever I go on and start keeping up with a running total of that. I'm going to leave the zeros off just for the sake of time. All right, let's scroll down a little bit here. All right, now I'm going to sell 7,000 shares. Oh, real quick, let's come back over here. Issued and outstanding. All right, so issued is 240. Remember, once again, the only time we change the issued shares is when we issue more or when we retire shares. That's the only time. All right, outstanding, we just sold 5,000 back, which means there's now 230,000 shares in the hands of our shareholders. All right, so on August 1st, all right, so we are going to sell some more. We sell 7,000 shares, and this is at below the cost, original cost, but that doesn't really change too much. I mean, we're still selling 7,000. Our cash number is still going to be how many shares times the sales price when that's 98,000. Skip a space here. We are still going to take treasury stock off at cost. So the original cost was 15. So that's 105,000. And then we can see our difference here is 7. Now remember, once again, the rule on this additional paid in capital account is I can debit this account. I just can't make it to where it ends up over here as a debit balance. All right, so I can take 7,000 out of that account, additional paid in capital treasury stock, 7,000, and I'm fine. All right, let's run over here and do issued and outstanding real quick. So issue is 240. We just sold 7,000 back, so that means there's 237 back in the hands of shareholders. Now look, you can always do it quick. We originally bought 15. We've sold back 12 so far, which means we still have 3,000 shares of treasury stock. And if you look here, this is off by $3,000. All right, so that's always a way to kind of check your work there. All right, now the last one, September 1st, we're going to retire shares. All right, so if we retire shares, remember, I broke this up in the last video. You might want to go back and watch that one. I break it up into 3 steps. The first step I called unissuing the stock. So if you look up here, this is issuing the stock. So unissuing, so we had these 2 credits right here to common stock and additional paid in capital common stock, which means now I'm going to debit those for the $1 per share and $16 per share up there at the top. So I consider that unissuing the stock. All right, so that's going to look like common stock, additional paid in capital, common stock. So it was how many shares? 1,000 shares times $1. And this was 1,000 shares times the $16. And once again, I'm getting that from that original entry I wrote up to the side of the given information at the top of the page. All right, so this is 1,000 and this is 16,000. All right, skip a space here. All right, treasury stock, remember, always comes off at cost. This is step 2. Get rid of my treasury stock. All right, remember the original cost was 15. All right, so that's 15,000. All right, so notice this one's a little bit different. We have 17,000 in debits and 15 over here, so that means we need a $2,000 debit, which is different than what we saw in the example in the previous video where we needed a credit to settle this out. Okay, well, that's fine. Just put it into additional paid in capital, treasury stock. All right, so come up here, 2,000. And so that brings it up to 20. Now look over here, the issued and outstanding. All right, so once again, remember, the only time we change issued is when we buy some more or we retire shares. All right, well, we just retired 1,000, so that comes down to 239. Now remember, when we retired shares, the outstanding doesn't change. A lot of times, like I said, students want to like mess with this number here, but remember, look back up here. The 1,000 shares that we just retired were part of the original 15, and they were already subtracted up here in the numbers I circled. All right, so if I was to subtract it down here, it would be double counted. All right, I would have subtracted it twice. And another way to look at it is, if you think about it, I've got 2,000 shares of treasury stock left, and that should be the difference between those 2 numbers, and it is. Okay, so make sure you kind of work through that and understand that, because sometimes that throws students off, that last little step there. All right, so I'm not going to write out the equity section. I mean, really what it would have, if you look up here, I mean, it would look similar to this with these numbers being updated. We'd have the additional paid in capital treasury stock. Now on there, retained earnings is given as 105, and then we would back out our treasury stock at cost. Okay, so basically the treasury stock at cost would be subtracted. So without writing out the whole thing, so remember we have 2,000 shares left. The original cost was $15 per share. So in our equity, over here, if we were adding and subtracting all of our equity numbers, we would subtract the 30. Remember, we subtract it because it's a contra equity account. Okay, so it reduces the equity section of our balance sheet. Okay, so this kind of wraps up treasury stock. Like I said in the last video, this is one of your longer problems that we do in this chapter. This chapter isn't overly hard, so really have a good grasp on this, because chances are you'll see this as a problem or part of a bigger problem when your exam rolls around. Okay, so hopefully this helped. Please subscribe to my channel. It does help me out, and please share with your friends, and hopefully it will help them out as well. So we're going to continue on next one. We'll start getting into preferred stock, and then we'll continue on to dividends before wrapping up this chapter. All right, hope you're enjoying. See you next time.